Imagine waking up tomorrow and hearing just 5 words from the Federal Reserve. No rate cuts this meeting. At first, it sounds like boring financial news, but within hours, stock markets could swing, mortgage rates could stay painfully high, businesses could rethink hiring, and millions of Americans could continue paying more on credit cards and loans. One decision, millions of lives affected. So, why would the Federal Reserve refuse to cut interest rates, and what happens if they don't? Let's find out. For months, investors have been asking the same question: when will the Fed finally start cutting interest rates? Wall Street wants cheaper money. Businesses want lower borrowing costs. Home buyers want affordable mortgages. Families want relief from expensive loans. But the Federal Reserve has only one main job: keep inflation under control while protecting the economy. Sometimes those two goals work together. Sometimes they don't. To understand why the Fed might not cut rates, we first need to understand what interest rates actually do. Think of money like water flowing through an economy. When borrowing is cheap, money flows everywhere. People buy homes, companies expand, investors take more risks. The economy speeds up, but when inflation gets too high, the Fed slows everything down by making borrowing more expensive. Higher interest rates mean fewer loans, less spending, less demand. Eventually, slower price increases. That's exactly why the Fed aggressively raised rates during the inflation surge that followed the COVID-19 pandemic. Now, imagine inflation is falling, but not fast enough. This creates a difficult decision: cut rates too early, and inflation could return. Wait too long, and the economy could slow too much. This balancing act is one of the hardest jobs in economics. So, what happens if the Fed decides not to cut rates? The first impact is on housing. Mortgage rates usually stay elevated. For many families, that means buying a home remains out of reach. Higher monthly payments discourage buyers. Demand weakens. Home sales slow. Builders become more cautious. The housing market often feels the effects of high rates before almost any other sector. Next comes consumer debt. Millions of Americans carry credit card balances. Unlike fixed-rate mortgages, many credit cards have variable interest rates. When the Fed keeps rates high, borrowing remains expensive. That means more money goes toward interest payments instead of savings or spending. For families already living paycheck to paycheck, this can create serious financial pressure. Businesses feel the squeeze too. Imagine you're a small business owner planning to open a second location. If borrowing costs remain high, expansion becomes more expensive. Some companies delay investments, others postpone hiring. Some reduce spending altogether. Multiply that across thousands of businesses, and economic growth begins to slow. The job market is often the next area investors watch. Higher borrowing costs can reduce hiring. Companies become more selective. Job openings may decline. Wage growth can slow. Unemployment may gradually rise if economic activity weakens enough. This doesn't happen overnight, but it's one of the reasons why every jobs report matters so much to the Federal Reserve. What about the stock market? Many investors hope for lower interest rates because cheaper money often boosts company profits and increases demand for stocks. If the Fed keeps rates unchanged, markets may initially react negatively. Growth companies, especially technology firms, can face more pressure because future earnings become less valuable when interest rates stay high. But it's not always bad news. If the Fed keeps rates high because the economy remains strong, investors may eventually view that as a positive sign. That's why stock market reactions are often complicated. Interestingly, not everyone loses. Some people actually benefit. Savers can continue earning higher interest on savings accounts, certificates of deposit, and money market funds. Retirees who depend on interest income may welcome higher rates. Banks may also benefit from wider lending margins under certain conditions. High interest rates always create winners alongside losers. History offers valuable lessons. In the late 1970s, inflation became deeply embedded in the U.S. economy. Then Federal Reserve Chairman Paul Volcker made one of the most controversial decisions in modern financial history. He pushed interest rates dramatically higher. The result was a painful recession. Businesses failed. Unemployment surged, but inflation eventually collapsed. Many economists believe those difficult decisions restored long-term economic stability. That history continues to influence today's Federal Reserve. Officials know cutting rates too early carries its own risks. Of course, today's economy is very different. Technology is changing productivity. Artificial intelligence is transforming industries. Global supply chains remain vulnerable. Government debt is much larger than it was decades ago. These